So I looked at the futures contracts, and what I've seen is the activity on the futures contract has been much lower than normal.
That's a big sign. That's a very revealing sign that, hey, your labor market is slowly starting to crumble and feel the effects of the high interest rates. Monday morning, folks, and welcome to a brand new episode of Finmet Mondays. Quite a bullish week that we had last week for gold. We didn't expect 1900 to be broken, but that's what happened in spot gold. What did you make of how the markets moved?
Yeah, I think it was interesting what happened. I tried to look at the data and find out what actually happened last week and why did it happen. So I looked at the futures contracts, and what I've seen is the activity on the futures contract has been much lower than normal.
Yeah.
So that's where the speculative activity is, and what we're seeing is basically probably because a lot of people are gone on holiday, a lot of the traders are away. We didn't see that much activity. On the other hand, when gold fell below 1900 last week, there was a surge in physical demand, and that I think pushed the gold prices up. And when the gold prices went up, there was some short covering because maybe stops were hit, and that gave further momentum to gold, and we saw the levels, higher levels later on. So I think that's where the fundamental basis is.
Yeah.
Tell me in terms of technicals, where we stand and what's going to happen in the future.
Yeah, I was just going to point out that you were right about like the physical demand really kicking in, because the moment we hit this 1883 support right over here, you really see a move up, and that was unexpected. I think what helped was also some economic data coming in weak. I think that really helped gold. But more importantly, Sunil, what I wanted to draw attention towards is how markets are going to move next week. So here you see there are two resistance bands. There is one from the 1931 to 1936, and the other one is from the 1975 to 1985, right? The blue line depicts what I think is going to be the prediction for the coming week. I think there's going to be a test of this resistance region, and we might see a correction post that. Now, what the correction might result, like whether or not we break this resistance band, depends on a couple of factors, and I think we can draw from the economic calendar that we have. Right, on Thursday, on August 31st, we have the PCE price index releasing, right, and we're expecting that there's going to be a 0.2% rise on a month-over-month basis. Right, the other data point here is the non-farm payrolls. We've been seeing non-farm payrolls stagnate month over month, just in terms of how the labor market has been performing. Now, this is going to be very interesting, right? If you see that the forecast of 180K, we don't meet this 180K number. We come much lower than that. That's a big sign. That's a very revealing sign that, hey, your labor market is slowly starting to crumble and feel the effects of the high interest rates. Maybe the Fed might want to back out, and that's when you might see this resistance region not act as a resistance anymore, and you might actually see this break and move forward to the next resistance band. So it all depends actually on how economic data comes through. I think that's what my what my bet is going to be. But I would ask traders to position themselves in such a way that you take targets around this region and wait for the data to play out before taking any further moves. Well, thanks Sunil for your input. Let's wait and watch how the markets play out. But till then, thank you so much and goodbye.